Hello, everyone. This is Ted Bauman here, Banyan Hill Publishing, editor of the Bauman Letter. We're here with your weekly Market Insights podcast, and I'm here with Mike Carr. Mike, how are you today?
Great, Ted. How are you?
I'm great. I'm great. Thank you. Not as actually a little bit better than the markets are today. And the last couple of days, it's been up and down. It's been crazy. We know that one of the big drivers of yesterday's drop was discussion of the dreaded uh, inverted yield curve. Can you explain just briefly what that means, Mike, before we start talking about what to anticipate from it?
Sure. So, if you were to go for a car loan and you called your bank and said, "What's the rate on a car loan?" They would say, maybe we'll give you a loan at 3% for 3 years, 4% for 4 years, 5% for 5 years. The longer you're going to take to repay it, the more risk the bank is taking on that you're not going to repay them. So they charge you a higher rate. The difference between those rates is known as the yield curve. And when the yield curve is inverted, it's upside down. So you call your bank and they say, well, we'll give you a 3 year loan for 5%, or you can get a 5 year loan for 3%. Now, most of us are going to take that 5 year at the lower interest rate, and banks don't do that. It's very unusual when the yield curve inverts, and that's what we have in the market right now. Is basically long-term debt is on sale.
Now, this is supposed to be a major warning sign for the economy and for the stock market. Why is that? I mean, what's the background to this panic that we're facing?
So, from my perspective, what's going on is investors, business owners are nervous about the short term. They're not willing to borrow to build up inventory because they're worried about the next year. And as they do that, we're seeing just rates go crazy across the board. And basically, it's nobody's real certain what the short term looks like. And therefore, you have to kind of just keep the economy going. The Fed's trying to race to react to this. And it's generally sentiment right now, I think, that lowered the yield curve. We're just seeing a great deal of nervousness, maybe related to tariffs. And I know you're following this story where we saw the CPI, the inflation data, came out earlier this week, and it showed a large increase in the price in electronics, the largest on record for that data series, a 23-year high in the price of furniture. And what those two things have in common is they're imported from China. So within an hour of that report, for some reason, the Trump administration announced, wait, we're not going to put those tariffs in place. I'm sure it was a coincidence. I don't know what your thoughts were on that.
Well, I doubt it was a coincidence. I think it's a question of just being politically realistic. Now, on the question of the yield curve, one of the things that the press has been covering extensively is the fact that yield curve inversions have preceded, I think, the last seven recessions, certainly at least the last five. There's some debate about it. Um, Ignoring the mechanics of how a yield curve can anticipate a recession, what do you make of the press reaction? Is it justified, or do you think it's overhyped?
I think the press is, as usual, following history. And you're right, it's followed all these recessions in the past. And I know you're an economist, and I'm going to say something that economists always tell me never to say. This time is different. And in the past, yeah, yield curve led to a recession. But this time, we might not get that stock market reaction that we normally see during a recession. Typically, in a recession, the stock market, the S&P 500, declines 35 to 40%. This time, there's no alternative to stocks. It's that TINA market. So we may not see the big sell-off. Dips like we saw yesterday with the Dow down 800 points might be a buying opportunity for these pension fund and institutional managers who have got to put money to work somewhere.
Yes, and I think that's a good point. And it really leads to my main comment on this, which is that it's important to distinguish between the real economy, which is affected by recessions, and the stock market, which is affected by bear downturns or corrections or crashes. And I think you're right that this time it's different in the sense that because there really aren't any alternatives to the stock market, we're likely to see less of a downturn in stocks than we normally would. And on that point, I think it's important to point out that the average gap or time gap between when the yield curve inverts and when we see a recession is about 22 months. So we still have up to 2 years to go before, historically speaking, it could actually cause a recession. On the other hand, when it comes to the stock market, the average gap between the appearance of an inverted yield curve and a downturn in the market is about 15 months. And during that time period, we normally see about a 15% increase in the overall level of the market. So if things are normal, if things aren't different this time, there's still room to run for the stock market. My take and my worry is that with the tremendous instability in the not just in the United States, but in the whole environment with Brexit and Hong Kong and the Persian Gulf, and of course with the president with his tweets, we can't really rely on that kind of timeline. Shouldn't we be expecting perhaps a number of short-term panics to turn into something more drastic on the downside, do you think?
I think it's a great time to be trading put and call options, of course, but the problem I see right now is the data is confirming a lot of problems. Just this past week, we saw industrial production decline in the US, in China, and in Germany. And as you mentioned, Brexit, that's coming, and it's like that train tunnel. You see the light coming at you. We know it's going to hit October 31st. And I don't believe Boris Johnson is going to blink. I think he will stand in the middle of the tracks and let the train hit him if necessary, just because he feels that's what he was elected to do. And maybe it's nice to see a politician stand up for what they believe in for once.
Yes. Well, I suppose the real question is whether the rest of the parliament in the country agrees with him. But I mean, my point, I think, is that under normal circumstances, the U.S. government, particularly the Trade Administration, the Secretary of State, etc., would be working to soothe these kind of problems in order to try to smooth out the pathway for a weakening global economy. Here we have kind of the opposite. We have both the United States and the UK, in a sense, raising tensions at a time when the German economy seems to have moved already into recession. Chinese manufacturing output is weakening. Chinese credit growth remains weaker than the government wanted. So there are a lot of things that are pointing towards a potential global downturn, but the U.S. government is kind of doing the opposite of what they would normally do. Does that not perhaps encourage bond traders to pile into the longer-term treasuries and the 10s and the 30s, which is part of the reason for this conversion?
It could very well be. And I know you follow international markets, and bond traders have just been seeking that long yield for so long. I think Argentina is a great example, where less than 2 years ago, they sold 100-year bonds. And now it looks like they may default for the 9th time in the past 200 years. So I do think bond traders are just reacting like stock market traders for once. We used to say that bond market traders were the smart money in the markets. They're just chasing yield now. And I think we are going to see them just go wherever they can get a little bit more return.
Right. And of course, if there's a perception that stock market yields as high as they may be, or returns as high as they may be, are risky for any reasons, then that would, of course, lower the risk-adjusted premium, rather than the risk-adjusted returns, again, pushes people into long-term bonds. So in general, I think we can say that what we're seeing today is a combination of economic fundamentals, but also just overall uncertainty, and that's pushing money into the long term. And that in turn is causing this inversion. So whether the yield curve predicts another recession as it has the last 7 times, it's hard to say. Mike, you're not sure it will. I'm not sure it will, but if it does, I think it'll come quicker than it usually does. That's my point of view. So any final thoughts, Mike, before we wrap up?
Yeah, I think this is not an environment for buy and hold. I think that was the right move years ago, but you've got to be more active now and more aggressive in managing your assets to preserve wealth.
Absolutely, and I think that's a good point. Then that's why it's important to pay attention. If you subscribe to Banyan Hill products, make sure you read our trade alerts, make sure you act on them, because that's our philosophy. We're trying to make sure that any kind of an uncertain environment, you preserve capital before anything else. So that's it for us this week. Thanks very much from me and Mike Barr with this week's market insights. Make sure to check out our YouTube channels. Make sure to check Banyan Hill's channel, our own personal channels, and of course, you can follow Sovereign Investor Daily and Market Insights there as well. We'll see you next week.